Exploring retirement income extends beyond traditional pensions and Social Security, encompassing a variety of sources to ensure a stable and comfortable retirement. Personal retirement savings like 401ks, IRAs, and solo 401k plans are important tools, whether you're at a larger company or self-employed. Planning for retirement income involves strategies that can include annuities, dividends, and interest payments. Each option must be tailored to individual circumstances and financial goals. Diversifying income sources is crucial. Options like rental income, part-time work, and royalties can supplement traditional income, offering flexibility and security. Annuities can provide guaranteed income, and understanding the types, fixed, variable, and indexed, is important for retirement planning. Likewise, passive income streams like rental properties or dividends require careful planning. Integrating these sources into a comprehensive retirement plan involves assessing risk, navigating tax implications, and planning for longevity. Strategies like diversification and tax-efficient withdrawal methods are essential to maximize these alternative income sources.
Colleen, what does your research say about bonds, stocks, annuities, and real estate as sources of income?
So for the most part, I would say that having a balanced portfolio of stocks and bonds, right, is certainly a prudent place to start. When you think about adding in annuities or any other forms of guaranteed income, we generally try to advise investors to really think through how much guaranteed income do they want beyond Social Security, right? So if Social Security provides a base level of income, an important decision is when to start taking that Social Security, because that really is like an annuity for many investors, and they may not realize that if you wait to take it until at least full retirement age or after, you get an 8% increase for each year after full retirement age, inflation adjusted. So I would say Social Security, I'm kind of like jumping a little bit, but like the first form of annuitization for many people is their Social Security, and the decisions around that are extremely important. Then after you look at that relative to, say, maybe your fixed expenses, right? So what are the expenses you need to live every day? If there's a gap between the fixed expenses and the amount that you are receiving from Social Security, many investors do consider having some sort of guaranteed income to fill that gap. So it's certainly, a piece of the portfolio, but I would say the large majority of the portfolio, right, would be more than adequate to have a prudent spending rule and a balanced portfolio between stocks and bonds.
Mm-hmm. And I think you've had professional roles building and managing pension and retirement funds for large organizations. What type of investments are the most likely to generate the returns that people need?
So we were joking right before we kind of went live about getting really geeky. So I can get really geeky. It's tempting. But there's a real challenge, right, between trying to generate returns. And if you're in your 60s and 70s, you really have to think about living for another 30 plus years with not wanting to lose money because, the markets go down sometimes. And so when we think about designing sort of post-retirement strategies and withdrawal strategies, my former role was designing and running a target date funds, which are designed to get people to and through retirement. And the riskiest part of the process, right, of a portfolio's risk is really at the moment when you're switching from putting money in to taking money out. And we talk about dollar cost averaging when we're buying things. When you're selling things, you have to worry about dollar cost ravaging, because if you sell when the markets are down, you're going to never get those monies back, right? Your portfolio is never going to recover. So there's two different concepts here we can kind of think about. One is the total level of risk in your portfolio, which is largely driven by the sort of stock bond mix. And the second one is you touched on just now, Andy, is what kind of income generation are you trying to generate from that portfolio? And there's a real balancing act that I think has to take into account your tax situation, what income tax bracket you're in, your level of comfort with the kinds of risks that you might be running, because in the long run, right, a more aggressive portfolio is going to work out. But if you need to be selling something every year to fuel your lifestyle, right, that's very risky. Assets in particular that generate income, right, or fixed income, obviously you get those coupons. High dividend stocks are great. Real estate is great, and I'm going to stick another hat on and just mention that I'm on the board of a private markets firm called Partners Group, which is a Swiss private equity company that also has strategies that can be utilized by high net worth individuals. And private assets like infrastructure and real estate, as well as doing the classic, I'm buying and managing some rental properties myself, are also really great ways to generate income, although they are expensive, right? So that's another variable, right? How much are you paying for these things? I will absolutely echo Colleen's comment that some people may find it very beneficial to raise their guaranteed income floor above and beyond Social Security by utilizing some kind of annuity. And that, I think, is a great way to get peace of mind and maybe let you take a little more risk with your investment portfolio as well. So you do have some more growth available to you.
It has felt a bit challenging just because in the past 3-4 years, the cycles are happening so quickly. And I think for most investors, doing less rather than more is typically better, especially in times of volatility. Fritz, I'm wondering, since you are retired, have you run into any pitfalls of managing multiple income streams in retirement?
Yeah, Andy, I think the big thing to feed on what Ann was saying, obviously when you move from accumulation to withdrawal, that's a major transition, and you have to position for that, preferably, a year, 2 years in advance. And the biggest thing I did is we built up a cash cushion of 3 years of spending. And obviously the market's been pretty volatile since I've retired. Very good for the first 4 years, and then obviously rocky the last 2 years. But it's rebounded now, so we've been able to replenish the cash. I'm blessed with a pension, so that's fortunate. But we are withdrawing from our investments. So it's surprising though, Jim or Andy, I have had such a small amount of anxiety. It's not a big issue. I've been through a lot of bear markets during my career. I've got about 60% stocks, maybe 30% bonds, maybe 10% of that is cash, and then 10% alternatives. So I've been able to find things that I've had to sell when I've had to generate a little bit of cash. But again, with a 3-year cash buffer, which normally in my working years, that would have been maybe 6 months, right? An emergency fund. Having some additional cash, especially now with the higher interest rates that you can earn on it, it's less of an opportunity cost. That goes a long way to calming you down in retirement and giving you time to be patient to allow your other asset classes to rebound before you have to sell them to fund your retirement.
Yes, a 5% interest rate has been a nice benefit. People sleep a little bit better at night. Roger, any innovative strategies that you've used for your clients, or is it a matter of keep it simple?
Well, I'm going to say something that may sound a little weird, but I think one of the biggest problems with retirement planning is that it's financial people coming up with things to solve for income. It's not a financial issue in terms of an investment product solution, which is how we always tend to approach it. And when we talk investment products, whether it's an annuity or real estate or something else, that's really optimization. And there's a lot of things that we got to get to before optimization. So the way that we organize it with clients is we're more project managers than investment managers. And you want to think of this in pillars. So the first pillar is, what do I want, right? That's your vision for your life. That, your values, which bleed down into your goals, which bleed down into cash flows. And then, is it feasible on the long trajectory of your retirement, given the social capital, whether you have Social Security or pensions, the human capital, whether you have rental income, you're working part-time, and your financial capital? You have to do the work to know whether this is feasible from a long-term sustainability standpoint. Then you got to get down to, is it resilient? Because it doesn't matter whether it's feasible for Roger to sail across the ocean. If Roger isn't prepared, he could, have a storm come and just wipe him out in the first day. Then you have to get to, how do I make it resilient? And the way that we approach resilience, our baseline is that you need to have 5 years of expected outflows from your financial assets de-risked. Because the two big risks you have in retirement are, number one, sequence of return of those bad markets up front. And then on the other end of the spectrum is inflation long-term. And so by having that 5-year income floor, it gives you a lot more flexibility and agency, not just simply to weather markets, but to weather bad assumptions and the change in life and everything else. After all of that basic work is done, then you can get down to the optimization of what investment strategy do I use for all these individual buckets. But I think this is much more of a project management and decision-making exercise than it is an investment issue. And sometimes that can get lost because we're all investment people and we love to talk about all the geeky investment stuff.
That's a great point. What if you don't have 5 years worth of assets that you can de-risk? There are those who are they're more borderline. They're able to.
Oh, that's a great point. So what do you do? Well, at that stage, you're going to get to where their plan is probably not feasible from a long-term trajectory standpoint, right? So if they don't have enough assets to support the goals, those base great life is what I call the needs, and then the discretionary spending, then the negotiation has to happen to get to a feasible plan of record, right? And you're going to have to look at what options do you have if you are very constrained or underfunded. And bluntly, it may be that you have to sacrifice goals, or you have to work longer, or you have to settle for less. You have to work through that at an individual basis to figure it out. It's not like there's going to be any wonderful solutions if you're underfunded. And from a tactical perspective, just to hit towards Colleen's point, usually it's the people that are most constrained or underfunded. From a prudence perspective, they are the ones that probably should be looking at guaranteed income sources more than most, because what seems counterintuitive because, well, I need more risk so I can get the returns, but that's like going to the poker table and trying to make up for losses. The downside, the impact of a downside return is asymmetric compared to getting those returns. So really, those are the ones that should be looking at more secure sources. I mean, it's difficult.
Yeah, it's a delicate balance. Don't bet it all on black.
Never.
We're going to go to the next segment.